We commented last week about the lack of volatility in markets and the fact that markets were proving to be very stable, a situation that we thought may not be sustainable, and indeed it didn't take long for markets suddenly to stir into a little bit of life. Now what drove that particular situation was again Europe. I'm going to pull up this chart here of the Spanish CDS spread, and apologies for the technicality here, but this is the cost of, in effect, insuring against a default in Spain. Not something that anybody expects at all, but we are well aware of the situation with Ireland, also Portugal and Greece, and those are all economies to some extent that the market feels can be resolved, and that they're not big enough numbers. The worry is that if the contagion spreads from some of those smaller countries into larger countries which are weak at the moment, such as Spain, and Spain is the highest on the list, then clearly that would be a concern to financial markets. So this chart here, which is the CDS spread, as that chart rises higher, as we saw at the beginning of this week, that is when stock markets can fall and tend to react quite negatively to that. It's an indication that things are not improving in Europe, and indeed that we may have another flood of problems in Europe which will need to be resolved. So at the start of this week, we can see that the CDS spread rose quite quickly. Thankfully it has tailed off a little bit, and so any concerns have been appeased. But if we now pull up the chart of the VIX, this is the volatility that's being displayed in financial markets at the moment, and again you can see that that caused quite a big jump. Now bring it back into charts that we are familiar with. Let's look at the FTSE 100. We have been range bound now for a period of literally 6 months, just intercepted briefly there by the Japanese earthquake, but we can see there a very tight range topping out at 6,100 with the low end of the range at about 58.50. At that level we breached this week temporarily, and for some traders it was a feeling that we may be testing new low territory and moving into a new lower range. I think encouragingly since then we have had a bounce back. We've got ourselves back into the range, telling me that despite all of the bad news, despite what's going on in Europe, equity markets feel uncomfortable being below 58.50, and that we do see buyers coming through. Now news flow, no question, around the world is turning a little bit for the worse. We have had GDP numbers, for example, in the US. These are the quarter-on-quarter numbers. The hoped-for number there was 2.2%. It came in at 1.8%. We also had jobless numbers coming in the US, and again those numbers came in higher than expected. So if there is a sense at the moment, it is that the recovery that has been in place over the last 24 months or so is running out a little bit of steam, and so that's why I sense equity markets are bumping along towards the low end of the range. Now one stock that when we talk about the economic recovery here in the UK is a surprise to see at the level it's trading at is Lloyds Bank. Lloyds Bank, as you can see over this sort of fairly long dated chart that stretches back to 2006, we can see the impact of the financial crisis. We can see the low levels that were achieved during the sort of depths of the crisis before the government stepped in, and then since then we've had this recovery that's been built into Lloyds share price. Now I think it's interesting to say that despite everything that has been thrown at the economic recovery, that Lloyds share price still remains very much towards the low end of its range. We did hear this week from one of the big rating agencies, Moody's, that they may well downgrade 14 of the financial institutions in the UK, Lloyds particularly being one. I don't think it's too much of a concern at this stage. I think all that they were highlighting is that these banks would not have the current rating, current credibility without government support, and because the government have said that they shouldn't rely upon this in the long term, I think these rating agencies are going to start to price in these banks as if they are independent bodies. One final chart I want to show up is oil, and just remind ourselves that oil prices remain at high levels. Here we've got Brent crude. We saw obviously this move up towards sort of April, which tailed off a little bit. This was driven, I think, largely by hot money coming into oil, protecting itself against the troubles in the Middle East. We saw a retracement, but it has now found a bit of a range. There was a comment out from Goldman Sachs this week that they're targeting a $130 oil price at the moment. My only observation about that was when they made the last call just about 2 months ago on commodities being too high. Commodity prices did react very, very quickly to the downside. Now, I'm not suggesting necessarily that oil may quickly move back up to their target of 130, but do keep an eye on that, because of course as oil starts to venture 115, 120, 125, that will also act as a bit of a brake on the economy, and at the moment I don't think the US economy, for example, needs brakes.